Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Management. Today's topic is stock buybacks. Now, stock buybacks have been in the news a lot lately. They're somewhat controversial. We wanted to lay that all out. What are they? The pros and the cons of them, and who's participating. All right, so let's start. What are stock buybacks? Well, that's when a company goes into the stock market, right? They go into the secondary market and they buy up existing shares outstanding, right? It's that simple. And there's not a whole lot of rules around what they can do. There's something called the 10b-18 rule that's the most important. And that has two main characteristics. It says firms cannot buy their own stock back, buy back their own stock around the earnings announcement. All right? And the second component to it is that firms cannot purchase over 25% of the recent average daily volume. That's it. All right? That's it. Other than that, firms can do almost whatever they want. Now, recently we have had this wave, right? This tsunami of firms that are either cutting their dividend or canceling their stock repurchase plans, or both. Let's take a look at some of those names on that list. We got AT&T, Nordstrom's, McDonald's, Best Buy, right? Some of the biggest service providers that were doing this in the past, right? Some of the bellwether firms that were doing this in the past have canceled their stock buyback programs. But it's not only the service providers, right? Most of the entire financial industry has canceled theirs. Airlines, Delta, United, also Boeing, etc., 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 right? More and more firms are canceling their stock buybacks. So let's all walk through, the pros and the cons of this. So recently, first we got to put this in magnitude, right? Over the last 3 years, U.S. corporations have spent over $2 trillion. $2 trillion of earnings in the last 3 years have went in stock buyback programs. $2 trillion. Does that number sound familiar? You say, shit, fat man, that $2 trillion, I've heard that number here recently. What is that? $2 trillion. Well, it's the size of the massive release package that was just passed by Congress. Wow. Stock buybacks for the last 3 years and the massive relief package. I wonder if they have something in common. Now, airlines get picked on a lot. And rightly so for the most part, right? Airlines were guilty of buying back a lot of their stock. But again, look in the corner here. Airlines only accounted for 1% of that $2 trillion. 1%. So this isn't just due to the airlines. A lot of companies were doing this. Now, why were they doing this? Because they were flush with cash. Due to the tax cuts of recent, they have been flush with cash. We went from a 35% corporate tax rate down to a corporate tax rate in the low 20s. And that generated a lot of earnings, right? Earnings that used to have to go to the government are now free to be used however the company sees it. And they have been using these largely to purchase stock buybacks. Now, not all stock buybacks are bad, right? Just some of them. I'm sorry. Not all stock buybacks are bad, just most of them. Now, it's pretty easy to separate the good ones from the bad ones. Let's start by thinking about what can a company do with the earnings they have, right? And they really have four major choices. They can take those earnings and pay them out to the shareholders as dividends. All right, option one. Option two, they can plow them back into the company, reinvest for the future. Option three is they can grow inorganically. That means acquisitions, mergers, carve-outs, things of this nature. That's inorganic growth. And option four, of course, is buybacks. Now, the buybacks we're talking about are in excess of dilution. What in the hell does that mean? Well, all companies give out stock options and stock grants to their senior employees. That's commonplace. And when these stock options and stock grants are exercised in the marketplace, that creates a dilution effect, right? It increases the number of shares outstanding. And historically, that's what buyback programs were used for. Companies would go into the market to offset the dilution that was created due to the compensation packages. But in the last 3 years, we've seen stock buyback programs far in excess of this dilution amount. All right? So when we say buybacks, we are talking about more than just offsetting dilution. Now, when a company buys back its stock, it reduces the number of shares outstanding, right? That's easy enough. Well, if you reduce the number of your shares outstanding, your earnings per share are affected. All right? So you can even have declining earnings, but your earnings per share go up because your stock buyback program more than offset the decline in earnings. And that has given rise to some short-term gains. All right, think about this. Think about this again. If every day throughout a quarter, a company can purchase up to 25% of its trading volume. All right, all that trading volume is one way. Buy, non-stop buying. Obviously, it's going to help support prices, if not drive them up in the short run. Well, let's take a look at earnings outside of the U.S. Earnings per share outside of the U.S. has been falling, and it's been falling for a long time. Right? Each bar on this chart is a month. The point is, earnings have been falling outside of the U.S. long before the coronavirus. What's the U.S. look like? Same chart, just different constituents. Now we just got U.S. companies. It looks just to be cresting in the U.S., right? Just to be cresting. So while everyone else had started to roll over, the U.S. had this spurt. And again, that was in large part due to the corporate tax cuts. So how do we sort the good ones from the bad ones? Well, it's pretty easy. It focuses on the top two things, right? If a company's doing this, doing stock buybacks, and they're maintaining their CapEx spending, and they're doing it without taking on debt, wow, that's good. That there's nothing wrong with those stock buybacks. It's when you start reducing your CapEx spending, and we're going to see in some GDP numbers next week. We'll have the CapEx spending in those GDP numbers, and we'll see U.S. companies have been slashing their CapEx spending for the last few years. CapEx has been going down. So we've been robbing Peter to pay Paul. Right? We are financing these stock buyback programs by not reinvesting for the future. And even worse is something known as capital restructuring. That's when firms take on debt, increase their leverage ratios. So if they're paying for these stock buyback programs by not investing for the future and by issuing debt, that is pure and simple value extraction. Value extraction. Those are firms that are focused on their competitors. They're focused on their short-term price performance. They're not looking at their end users, their consumers at all. Now, this last point. One of the problems with the stock buyback programs is corporate executives that tell you they were forced. What does that mean? Well, treasurers know about the shortcomings of stock buyback programs, and they'll tell you, they had no choice. Treasurers had no choice because the CFO was making them do it. The CFO says, I don't have any choice. It's the chairman, the CEO, that's forcing me to do it. The chairman and CEO says, I don't have any choice. If I don't do this, an active investor will come in, replace the board, and vote me out and put somebody in that will execute this. All right. It's a deep-seated problem. No doubt about it. It's a deep-seated problem. But every crisis presents an opportunity. And I'm hoping when we get to the end of this crisis, right? We have a healthcare crisis that has given rise to a financial crisis. And I am hoping when we get to the end of these crises that we get some sort of legislation that addresses this issue. Because as you all know, any of the regular viewers, these stock buybacks have put the dill in my pickle for a long time. And I hope eventually they will be addressed. All right, that's our message for today. I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed this. May your beer be colder than the company you keep. We'll talk again soon. Thank you.